Private equity buyout funds have quietly delivered some of the highest investment returns in the history of finance. We're talking about average annual returns of 15 to 20% consistently over decades. For context, the S&P 500 averages around 10% a year. Hedge funds average around 6 to 8% after fees. Private equity buyout funds are lapping both of them. So why isn't everyone doing this? Because you can't. The minimum investment starts at around $5 million. These funds are close to ordinary investors entirely. But understanding how they generate those returns, that's where the real education is. Because the strategies they use reveal something most people never learn about how money actually works at the highest level. Let me break that down for you. First, what exactly is private equity buyout fund? A private equity firm raises a pool of capital from institutional investors, pension funds, sovereign wealth funds, university endowments, ultra high net worth individuals. They use that capital to buy entire companies, usually ones that are underperforming, undervalued, or going through a transition. They take the company private, meaning it's no longer traded on a stock exchange. They restructure it, improve it, grow it, and then sell it 3 to 7 years later at a much higher price. The profit from the sale minus fees goes back to the investors. Simple concept, the execution is where it gets fascinating. Here's exactly why it works so well. Reason 1, leverage. They buy companies with other people's money. This is the single biggest driver of private equity returns and the least understood by most people. When a private equity firm buys a company for $1 billion, they typically put in only 2 to 300 million of their own capital. The rest, 7 to 800 million, is borrowed debt, usually loaded onto the company itself. This is called a leveraged buyout, and the math is extraordinary. If that company grows in value from 1 billion to 1.4 billion, a 40% increase, the equity holders don't make 40% because the debt stays roughly the same. The 400 million in value growth goes almost entirely to the equity. The firm's original 300 million investment has now grown to 700 million. That's a 130% return on a 40% increase in company value. Leverage amplifies return dramatically on the way up. It also amplifies losses dramatically on the way down, which is why some leverage buyouts end in bankruptcy. But when it works, the numbers are staggering. Reason 2, they don't just own the company, they run it. When you buy shares of Apple or Amazon, you have zero influence over how those companies are managed. You're a passive passenger. Private equity firms own the entire company. They replace management if needed, they cut costs, they enter new markets, they make acquisitions, they restructure the entire business model if that's what it takes. This level of control is something no public market investor ever has, and it matters enormously for returns. The best private equity firms have entire operational teams, former CEOs, industry specialists, turnaround experts, whose entire job is to go inside the companies they own and make them significantly more valuable. They're not betting on a company, they're engineering its outcome. When you compare this to a hedge fund manager staring at a Bloomberg terminal hoping a stock goes up, the difference in hands on control is the difference between a passenger and a pilot. Reason 3, they buy cheap and sell expensive in the same market. This sounds obvious, but the mechanism is more sophisticated than it appears. Private equity firms typically buy companies at lower valuation multiples than the same companies would command if they were publicly listed. A private company with 10 million in earnings might be bought for 80 million, 8 times earnings. That same company, once grown, cleaned up, and taken public through an IPO or sold to a large corporation, might now command 12 or 15 times earnings. So even if the company's earnings didn't grow at all, which of course they try to make sure they do, the firm would still make money simply by moving the company from private market to the public market. This is called multiple expansion, and it's essentially a built-in profit mechanism that has nothing to do with how well the underlying business actually performs. It's one of the least talked about reasons private equity generates the returns it does, and it's been quietly printing money for these firms for decades. Reason 4, they pay less tax than you do. Private equity fund managers are compensated through something called carried interest. This is their share of the profits from the investments, typically 20% of the gains. Here's a part that matters. In most countries, carried interest is taxed as capital gains rather than ordinary income. In the United States, the long term capital gains rate is around 20%. The top income tax rate is 37%. So, a private equity partner earning tens of millions of dollars in carried interest pays roughly half the tax rate of a salaried employee earning $100,000. The tax structure has been controversial for decades. Every few years, politicians propose closing the carried interest loophole, and every few years it survives, largely because the private equity industry spends enormous amounts on lobbying to protect it. The tax advantage doesn't just benefit the fund manager personally, it makes the entire investment structure more efficient and allows more capital to compound inside the fund rather than going to the government. Reason 5. They get paid extra just for locking your money up. When you invest in a private equity fund, your money is locked for typically 7 to 10 years. You cannot sell your stake, you cannot exit early, you cannot get your money back if you need it. That's an enormous sacrifice for any investor. In return for accepting that illiquidity, investors expect and historically receive a premium return above what liquid markets provide. This is called illiquidity premium. It's essentially an extra reward for patience and commitment. The interesting implication for this is that part of private equity's apparent outperformance over public market isn't purely about skill. Some of it is simply compensation for the fact that investors can't touch their money for a decade. A pension fund that can afford to lock capital away for 10 years gets paid more than a retail investor who might need their savings in 2 years. That structural advantage compounds significantly over time. But here's what the pitch decks don't lead with. Private equity returns are not guaranteed. Some buyouts fail spectacularly. When a firm loads a struggling company with 700 million in debt and the turnaround doesn't work, the company collapses, jobs are destroyed, and suppliers and creditors take enormous losses. The workers inside these companies often bear the real cost of the efficiency improvements through layouts, benefit cuts, and wage freezes, while the private equity partners collect their returns. And the performance data itself is complicated. Private equity funds self report their valuations on unrealized investments. Until a company is actually sold, the value is an estimate, and estimates can be optimistic. Some research suggests that the true risk adjusted returns of private equity are closer to public market returns than the headline numbers suggest. The access barrier also means the returns that do exist flow almost entirely to institutions and ultra wealthy. The pension fund manager benefits, the pension holder, the nurse, the teacher, the firefighter gets a fraction of it. Private equity buyout funds generate high returns for 5 compounding reasons: leverage, operational control, valuation arbitrage, tax sufficiency, and the illiquidity premium. None of these mechanisms are available to ordinary investors. The system is specifically structured so that the people who already have the most capital can access the highest returning investments. But understanding these mechanisms changes how you think about investing at any level. Leverage amplifies returns in your own investments too. Control beats passivity. Buying undervalued assets and selling them in better markets is a strategy that works at every scale. Tax efficiency matters more than most people realize, and patience, the willingness to lock money away and not touch it, is genuinely rewarded. You don't need $5 million to think like a private equity investor. You just need to understand the game. Next week, I'm breaking down another financial system that generates extraordinary returns for a very small group of people and explaining exactly how it works. Subscribe so you don't miss it. And if this one made you think differently about investing, send it to someone who needs to hear it. See you next week.